Hello everyone, welcome back to Upside Down Data. Today I want to talk about some new analyses I've been conducting looking at the typical ROI one could expect at a given UDPI level, say for example -2 or -3, across different periods of time. For example, the ROI after 6 months, the ROI after a year, etc. If you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter, where we put out regular updates about our risk indicators and more. So this video is really meant to be kind of along our series of videos we've been doing looking at validating our risk model. So, we have this risk model, the upside downside potential indicator, UDPI, that quantifies high and low risk points in an asset's price history. I'm showing you here Bitcoin. Later on in the video, we'll also talk about Ethereum and Cardano just as some use cases, some things to run these analyses on. And really what I want to look at today is when you're watching the UDPI across time, it'll be at some level, right? It'll be at some number that it's giving you. What I want to look at is, let's say, for example, the UDPI were to be at -3. So the UDPI has been around that level in the past different times. What I want to look at is when the UDPI is at -3, what does that usually mean that you can expect in terms of your ROI over some period of time in the future? So let's say it's at -3. What kind of ROI can you expect 6 months later? What kind of ROI can you usually expect a year later? What kind of ROI can you usually expect 2 years later based on that level? That's the kind of analysis I want to look at today. But before I get into that, I do want to give a shout out to Jay over at Daily Crypto Analysis. Jay recently gave us a shout out in one of his videos, so I want to thank him for doing that. That was very kind of him. And I want to welcome anyone who came over to the channel, is checking it out based on that endorsement. And if you haven't checked out Jay's channel, I really highly recommend you do. Jay has a really rational and data-driven approach to the crypto markets that I think is really great. I think he puts out high-quality content, takes the emotion out, takes the hype out, really tells you about what the market is telling you from a data-driven perspective, and I think it's very valuable. And really, I see Jay's philosophy as being very similar to our own here at Upside Down Data. So I'll leave a link in the description if you want to go and check out his channel. Again, can't recommend it enough. I watch his videos. They're very good. Okay, so let's get into these analyses I was mentioning. So what I'm showing you here is the upside downside potential indicator for Bitcoin, and I'm showing you here the output when the model is allowed to have full knowledge of Bitcoin's price history, right? So this is Bitcoin's entire price history that I'm showing you here, and just color-coded based on the UDPI. And these UDPI levels that is calculating at each different day, each dot here being a day, this is all based on it having full knowledge of the asset's price history. So one thing that you could be concerned about with that is, okay, but is it able to do that in real time, or is this all just hindsight, right? Is it just able to describe the past, but it wouldn't be able to do that in real time? Or is the UDPI able to call these high and low risk points in real time? So for example, if you had built UDPI at an earlier point of time and just let it run, would it be accurately identifying high and low risk points in time? So if you've seen some of our other videos where we've done some of these simulations or some of these analyses, you'll know that it can. So what I'm showing you right here is the price history of Bitcoin ever since late 2011. So essentially, I'm letting the model train on all the data before this point right here. So it's being allowed to train on this data. And then what I'm going to do for this, this chart, the way I've generated this, is I basically constrained the model to only have knowledge of that current day and then the asset's history before that day. So for this very first day here at the end of 2011, it'll have knowledge of everything up until this point, but zero knowledge of anything past this point. And then essentially, I just have the model calculate its UDPI level based on only this knowledge, and then just record it. And that's the UDPI level that's reflected on this graph here. So it's just based on this day and everything before this day, but no knowledge of anything past. And then you do that on the next day. So it'll know about that day and everything before, nothing since. Then you do that again and again and again. And so basically what I'm showing you here is this is what the UDPI would have been printing out in real time had you made it in late 2011 and just let it run. So it just started running here. These are the exact literal values it would have been producing had you just created it back then and let it run across this entire time. So, had you made it back here, or back here and let it run, this date in early 2012, this exact UDPI level is the level it would have set at that time. Getting up to the highest levels here during these mid-cycle peak and market cycle peaks, each one of these, that would have been happening in real time with this. And what's nice about this is that this can't be biased by hindsight, right? So, but because each of these levels is calculated without knowledge of the future, only knowledge of the past, there's no hindsight bias that's possible. So this can give us some confidence that the UDPI can accurately identify high and low risk periods in real time as they happen. It does not need to know anything about the future to make accurate predictions. It does not need any kind of hindsight bias. It doesn't rely on hindsight. It doesn't need that. It's able to do all of this in real time. And then we can see this if we just compare the two versions of the model against each other. So this is the model with full knowledge of Bitcoin's price history. And I'm just starting at the exact same point here, but this is knowledge of everything as it's assessing each day. And we can see that they're very similar. And in fact, if anything, I think the real-time version, the one that's just calculating based on that day and everything before, no knowledge of anything past, is actually, if anything, calling these points a little bit more accurately throughout. For example, the mid-cycle peak in 2013, this gets up to really high risk levels, whereas this, in the context of everything else, the model knows that this wasn't actually that risky because of what we did soon after. But in real time, it identified that as being a high-risk zone, low risk, high risk, low risk, high, low, etc. All of this is in real time, no hindsight bias. So that's great. That's the first thing that we need to establish, that the UDPI can do all of this in real time. We know that it can. So now what I want to do is look at the expected returns on investment using this simulated data, right? We don't really care about this so much because this is not reflective of what the UDPI would have literally been saying at the time, though it is similar to what it would have been saying literally at the time. This is the one that I want to base my calculations on. So if we had just created the UDPI back here, then looking at it every single day, looking at the value, what kind of returns on investment could we expect across this time period using these literal values it would have been giving? So the first analysis I want to show you is looking at 180-day ROIs. This is basically 6 months roundabout ROIs. And so essentially the way that this analysis is working is that I'm just taking every single day here, and then I'm just comparing the price on one day to the price of the day 6 months later, or 180 days later. So I'm just taking the one that's about 6 months later, and then just looking at the return on investment. The percentage increase is the way I quantified it. So how much is the percentage increase or decrease if it went down with that? And so that's what's on the y-axis here. It's just the percentage difference between that initial starting point and the day that's 180 days in the future. So of course what this means is that the last day that's being included is the day that's 6 months before today, because obviously we don't know what the ROI of today's price is. We don't know what the price is going to be 6 months from now. So that's just one thing to note with this analysis. So what we can see, this is a scatter plot, so each dot here is a day. Well, it's an ROI. So each dot is basically that percentage difference from one day in the past to 6 months later, and it's that percentage change. And so what we can see is pretty interesting. You'll see that overall there's kind of this this negative slope here. That's what this line is here. This is a regression line that I fit to the model. So this is just basically telling us that what is the best fit line to this on a linear sense. So is the line trending up? Is the line trending down? And we can see is that it's trending down. That's what this statistic back down here means. This B is the regression coefficient. Essentially what this means is if it's negative, that means it's a negative slope. So that means that as UDPI gets higher, the ROI you'd expect after 180 days is getting lower. So that's what that means. Don't worry too much about these other statistics. These are just inferential statistics. Essentially what this p-value is, you might have heard of p-values before, it's just giving you a sense of if the actual slope here was 0, how likely would be to see this negative slope we're seeing here. And by a p-value being really low, in this case well below 0.00001, that just means that it's highly unlikely that we'd see this if the actual effect was 0, is basically what it's saying. So it just gives us confidence that this slope here is legitimate. And if you're familiar with confidence intervals, that's what these red shaded areas are around this best fit regression line. So a confidence interval is just saying that there's 95% of the time, if you were to kind of have infinite random samples that you could draw from, or a bunch of different random samples you could draw from, 95% of the time, the line would fall within these shaded regions. The slope would be within these shaded regions. Don't worry too much about that. That's just some statistical things. But the takeaway from this graph is that we can see that overall, the lower the UDPI level is, the higher the 6-month ROI we can expect. Now, what's kind of interesting that you'll note is that the highest ROIs we're seeing are actually not all the way at the bottom. They're actually between -3 and around -2 or so. And I think there's a couple of reasons for this that we have to keep in mind. So again, the idea here is that we're just taking a day and then 6 months into the future. And if you look at Bitcoin's history, you'll note that from the very bottom of bear markets to these market cycle tops that we've seen, it usually takes it's basically always, from this whole history we're looking at here, it's always taken more than 6 months to get from the bottom to the top. So from that perspective, we wouldn't expect -5 to have the highest ROI necessarily, because, you know, if you're starting here, 6 months later, the price will have gone up, but not anything super crazy from here to here. Whereas 6 months before here, just look at how much higher the price has gone. You know, this is on the logarithmic scale. Look at those multiples. Same thing over here, same thing over here. So I think what we're essentially seeing is that for moves that start at -5, it just takes longer for them to fully develop. So really what this means is that if we're looking at a 6-month window, if you're sitting at -5, don't expect absurd returns in 6 months, because usually the moves take longer than 6 months to fully develop. We've seen that all the time with Bitcoin, pretty much. You know, from at least from where this simulation is capturing, where it's starting, that, you know, it took well over 6 months to get from here to here, but then it certainly did, and so our overall ROI here is quite high. But if you only project 6 months in the future, it's not going to be as high as, like, say, here to here, for example. And so what that means is that, in fact, if you're looking to just get a quick 6-month high return on investment, you'd actually maybe be looking for a UDPI level that's between these, and more than likely, this is a UDPI level that's happening on the upswing, right? So as price is increasing, it'll get up to -3, -2, and historically, that's actually been oftentimes when the 6-month ROI has been highest. So that's just something to keep in mind here. So if you had only a 6-month time horizon, then really what you'd be looking for is probably an upswinging UDPI that's breaking through -3 up into -2. Historically speaking, that's when those highest ROIs have been emerging. But overall, the lower the UDPI is, the higher the ROI. The way you can actually interpret this beta is that every point lower on the UDPI that it's been, you can expect a 7% higher 180-day ROI. That's what this beta can be interpreted as. Every point that decreases on the UDPI, there's a 7% increase in the 180-day ROI. Again, it's a negative relation. So, you know, as UDPI goes up, ROI goes down. As UDPI goes down, ROI goes up. That's how you interpret that. So let's look at 365-day. And what I think is interesting is we can see that now these super high returns on investments, they've shifted back. And again, that's consistent with what I was talking about before, that once you've given it a full year to develop, from, you know, 2012 to 2013 here, now prices had a lot more time to move from this very much bottoming point, from here to here. I should be using this chart. Or it goes from here to here. Look, there's more time across these points for things to develop. There's more time for things to develop. And so, for example, from here to here, that's a lot more time to move up. And so that's what we're seeing, that overall, this is what is happening. And I think it's important to know this is a kind of a rough analysis, right? Because we're just looking at exactly a year later. And the fact of the matter is that no cycle or no bottom to top is going to happen at any exact point reliably. It's not going to be exactly a year later or 2 years later or anything like that. So another analysis I want to look at in the future is kind of a maximum ROI, where you'd say, you know, from starting here and then projecting 3 years into the future, what was the highest ROI that was achieved? You know, based on whatever the beginning point was, what was the highest ROI you ever would have seen from there? And there you might be able to account for that a little bit more. So just keep in mind that these are rough, kind of crude analyses where we're just looking at the literal year later kind of a thing. But again, we see it shifting back. So here's around -3. That's generally offered the highest 365-day ROIs. But again, we're seeing this negative regression line, right? This negative slope on the best fit line across all these data points. And what this means is that every point lower on the UDPI has corresponded to a 94% higher return on investment. So you can imagine, you know, that's every single point. Go from 0 to -5, you know, add 90% to your ROI for every one you go down. That gets pretty high pretty quick. So that's what that is suggesting there. Let's look at the 730-day ROI, so about 2 years here. Here's where we can see now some of these -5s starting to flex their muscles, because now we're giving enough time for those market cycles to really start to develop. So for example, for the 2013 kind of run, we're getting close to starting to capture that move, or closer to be able to capture more of that move in just one data point here, projecting 2 years from the beginning point. So you can see that shifting back. Now it's between -5 and -4. We're seeing the highest ROIs. But again, we have that negative regression line slope. Every point down corresponds to a 616% higher ROI after 2 years. So whatever UDPI level it is, as you go down on UDPI, you can expect that much higher return over that time frame. So that's what that means there. And finally, I wanted to show the 3-year ROI for Bitcoin, just because I think this is interesting. Now, one of the caveats, of course, is that this is cutting out basically the entirety of the 2020-2021 run, because we're going 3 years back from today is the last data point that we have. So that's going to be all the way back in 2019. So just something to keep in mind. This is mostly just from that 2013 and 2017 peaks. Everything up until around 2019, projecting forward that we're looking at here. But again, similar story to what we saw before. And again, we're seeing this kind of shift back again to -5, -4, where the highest ROIs were. But it's also important to note that we just don't spend a whole lot of time between -5 and -4, so that's why so many of the dots are clustered at some of these levels, because we tend to spend more time in bear markets at these types of UDPI levels. Really, we only tend to get down here in like absolute bottoms of bear markets, historically speaking. But again, we see this negative regression line slope, so every point you drop on the UDPI level, you can expect a 482% increase on the 3-year ROI here. Okay, so that's Bitcoin, and I think what this all shows is that this does validate the UDPI approach, even though this is a relatively crude assessment, right? Because this is not about catching the absolute bottom and the absolute top, which realistically, if you're using the UDPI, that's probably more what you'd be doing, is you'd be accruing down here and then trying to sell in these really localized, concentrated points that are high risk. But this is just more, kind of ignoring market cycles in a sense, just saying, if I buy now, at this UDPI level, what is my kind of expected return over time? And we can use these regression lines to figure that out, this kind of best fit line to kind of figure out the typical or kind of expected return that cuts through. So if we're going to about -4, it would be around a 3,000 ROI historically, although with diminishing returns, you probably wouldn't expect as high of an ROI going into the future, but just historically, this has on average been what it suggested for 3 years. But again, with diminishing returns, that's going to be likely changing with time. But I still think that this shows value of the UDPI, whereas just even if you just ignore market cycles, just buying at a lower UDPI level will generally lead to a way higher ROI after any of these time frames than if you buy at the top, if you buy at these really high UDPI levels. Okay. So what I want to do now, though, is just look at another asset. So let's look at Ethereum. So here I'm just showing you the same validation in terms of simulating the real-time ETH UDPI levels across time. So this is the model with full knowledge of Ethereum's or of ETH's price history. This is the model that only has real-time knowledge. And you'll see that they're again quite close. We're starting here all the way back. This is only about a year after ETH was created that we're starting these simulations. So there's just kind of one pump that I used to train the model that came before this, and then we're starting after that. So you can see it's still learning a little bit during this pump here, but then after that, it's calling it very well. It's calling it very much in line with what the model with full knowledge of ETH's price history is doing. So I think that is quite reassuring. That's validating. It shows that this also is working in real time quite well. If you had built the ETH UDPI back here, it would have been giving valuable information the entire time through to today. So let's look at the different ROIs now for ETH. So 180-day, we see a similar thing that we saw with Bitcoin, although interestingly, we actually see sometimes where we're actually getting these really high ROIs off of -5 for ETH, and I suspect that's coming off of here, right? This is a really hot, low UDPI level here. It did not take a whole lot of time for this to develop, so that's probably what we're catching some of over here in this move here. So yeah, that would be my expectation there. And again, what we're seeing is this negative best fit regression line, right? So negative 39.82. So again, every point lower on the UDPI for ETH, you expect around 40% higher ROI over 6 months. Historically speaking, that's what's corresponded to. Look at the yearly ROI. Again, similar story. Again, seeing kind of clustering of the highest ROIs around the kind of -5 to -3 level. And again, this negative best fit regression line slope. So for every point you go down the UDPI, you expect, historically you've expected, or there has been expected, a 155% increase in the ROI for every point you go down on the UDPI. And this would be the best fit regression line. So this is kind of the typical expected ROI at these different points. So for -5, the typical ROI expected has been around 1,500%. Now again, with diminishing returns in the future, it might not be quite as high, but that's still quite good. That's still quite impressive in my opinion. And so let's look at the 2-year. There's not really enough data with ETH for this simulation to go all the way up to the 3-year, so I'm just going to stop with the 2-year here. Again, very similar story. We see kind of the highest ROIs kind of again being in this -3 to -4 range, maybe extending a little bit further up. Similar story, negative regression line slope. So this now for the 2-year, every point you go down has been corresponded to a 125% increase in your expected ROI over 2 years for ETH. So if the UDPI was sitting at -4, you'd be expecting around about 1,000% ROI in 2 years based on ETH's past. Although again, with diminishing returns, probably be a little bit lower than that. Okay, and finally, I want to look at Cardano, just being a younger asset that we can also look at and see what was going on. So I'm starting this simulation at the COVID crash, the March 2020 crash. So I'm using all the data for after the kind of the crash off of the 2018 high that ADA had put in, using all of that up until the March crash as training data, and then we're just starting the simulation going off of that. And again, they're quite similar. In fact, actually, this one would have been warning you that this was a bit of high risk coming down to the green zone. High risk, very similar kind of things here, just heating up a little bit more quickly on this move here in the real time than it did in the retrospective. But overall, very similar outputs between the two, which is good to see. You'd want to see the real-time output being similar to the post-hoc output, and that's what we're seeing. So I'm just going to show the 6-month and the yearly for ADA because we don't really have, we don't have time to be looking at anything really past that with this amount of data. And so again, we're seeing a similar story. So in the 6-month, again, the highest ROIs are being clustered at some of these levels here. And again, I suspect that's just because these moves played out in coming off of some of these points here. The really low UDPI level, we didn't get all the way to here in 6 months. It was more off of those levels we'd see that. So that's what we're seeing here. But again, negative regression, best fit regression line. So what that means is that for ADA across that time, every point lower on the UDPI was corresponding to a 55% higher ROI in 6 months, 6 months later, which again is quite good to see, I think. And you'll notice actually that in this time, anything below -1 on the UDPI was only ever associated with a positive ROI, and actually pretty darn high. So this would be a 250 ROI at -5, around that all the way through. So never a negative ROI over that time period, over this time period we're looking at, which I think is interesting. Although of course this is just looking at one market cycle, so that's something to keep in mind. So let's also look at the yearly ROI based on what we were just looking at. And here we see kind of a very clear effect here. We're now, we're looking long term enough that we can capture this entire move, being a year later, or at least start to capture these full moves. And so what we see is this very clearly linear trend here, right? Where the lower the UDPI level is, the higher the yearly ROI is. Very clearly. So every point down on the UDPI corresponds to a 343% increase in the yearly ROI over that time period, which I think is very reassuring. So again, if the UDPI is in these low levels, this is basically saying you can expect a pretty high year ROI after a year based on this data. Now again, if we went into a protracted bear market, some of that could change. Who knows what would happen then, because certainly the UDPI will hang out at low levels during bear markets, so these numbers might start changing. But based on this simulation, it's quite clear the trend. And I think the overall aggregate across all of these assets, Bitcoin, ETH, ADA, is that we just see that across all these different time frames we've been looking at, even with this kind of crude analysis, we're just ignoring market cycles. You know, we're not too worried about catching the absolute tops or bottoms. We're just saying, if I buy right now at this UDPI level, what's my expected ROI a year later or whatever? We're still seeing that there's a lot of utility to that, right? We're still seeing these negative regression slopes for every single one of these scatter plots that we've looked at. And what that means is that when the UDPI is low, you can expect higher return on investments across all of these different time frames than when the UDPI is high. And I think that makes total sense, right? That's the way it should be, because look, red corresponds to higher prices than green. So you should expect a higher ROI based on these green zones than these red zones. And so this is really just validating that observation. And so then if you were actually actively using the UDPI, you'd probably actually be beating out on these analyses in a lot of ways, because you'd be, you know, buying here, selling here, buying here, selling here kind of a thing. You wouldn't be just arbitrarily selling after a year necessarily. But that's what these are assuming. And even if you did take that kind of arbitrary approach, you would still be benefiting from having UDPI information to base that on. So overall, I think these analyses just provide more evidence about the utility of having these risk indicators. Because even if you just wanted to use this incredibly basic trading strategy of just, I'll buy here, then I'll sell literally this time period in the future, this gives a sense of what kind of ROI you could expect if you just bought at a given point in time. And then basically what this is saying is that if you wait to buy at these low UDPI levels, generally speaking, that's corresponded to higher ROIs across all those different time frames. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. And remember, with the UDPI, we're all going to make it.